Okay, hello. We're here at the Multifamily Graduate Podcast, and we have a special guest today. His name is Matthew Frank with Lument. Matthew, tell the audience about you and your company.
Sure. So I'm Matt Frank. I'm with Lument. I've been in the banking agency credit union world for 20 plus years at this point. I've been started on the banking side, moved over to the credit union side, and then moved back to the agency side, which is Fannie Freddie. They don't go to the open marketplace as Fannie Freddie like they do on the residential side. They go through seller servicers and delegated underwriter servicers like a company like Lumen.
And a big company like that is willing to lend a guy like me a couple of $1 million.
Sure is.
um, Matt, let me start off by asking you, what are the biggest challenges you see for your company, you and your company for that matter?
So the biggest things that we're seeing, it's probably three things: insurance, taxes, and occupancy occupancy seems to be percolating up on almost every deal I look at. But taxes and insurance, as you know, in Florida, it's a nightmare trying to get insurance. My
Yeah,
neighbor down the street here, and we don't have any natural disasters in Arizona. His doubled. His homeowner's insurance doubled.
it
uh,
doubled in Arizona.
in Arizona.
Wow.
So it goes to show you that you're going to have underwriting problems when you have insurance being high, taxes being high. It's all going to reduce the leverage that anybody can get. It doesn't matter whether they go to a bank, credit union, or an agency like us. It's going to reduce the ability to get 75% leverage. Texas, you're looking at 55 and below. California, you're 55 and below. Even here in Arizona, we're at 65. I think I did one deal at 70% last year, which is in previous years, we could get 60, 65 in California, 75, 80% here all day long. But we're starting to see almost across, because I lend across the country, we're starting to see that, the LTV that buyers are able to attain is in the 65, maybe 70 range at best.
Now in Arizona, why the rate hikes on the insurance? I mean, we know why in Florida.
They're trying to offset for Florida, Texas, and California,
Because
and
we
actually Washington and Oregon as well. So they're raising them across the board on everyone.
I spoken to some people in the insurance industry who are not selling,
Right.
and they're on the legislative side, and they think it's going to continue to rise. And I'm like, it's not sustainable. How could the property afford that?
Right. It's becoming a major issue. I know that internally they've been trying to figure out how to do a self-insured program. I don't know how many legs it's truly gotten, but it's definitely, the insurance companies are causing heartburn that everybody's looking for alternatives. And what that alternative is at this point, I don't know, but somebody will come up with something.
Well, the gentleman I spoke to, he works in Tallahassee, which is our state capital, and he was saying they were in discussions, but they discussions can take up to 3 years. He said,
Yes.
about possibly letting some owners self-insure, and
Yep.
that would be nice.
It would be
um,
nice.
so tell
And like I
me,
said, I think that there is movement on that. I just think it's going to take time.
yeah, he said it will definitely take time. So on the flip side of the previous question, what are the biggest opportunities that you see going forward in 2024?
I think the biggest opportunity is going to be deals are going to have to be traded. Unlike last year where sellers could sit on the sidelines, they're having notes that are coming due. Their insurance is affecting. I have a deal in Albuquerque that I'm working right now. They bought it 2 years ago. Their taxes doubled because somehow didn't get reassessed when they purchased it. So they went from $15,000 in taxes to $30,000 a year in taxes. That's putting some strain on there on, because now you have to figure out how to recoup that cost. But I do, with the notes that are coming due, the bridge lenders, the notes that are coming due, people that put 5-year notes on, that stuff's all going to mature, and they're either going to have to do cash in refinances, or they're going to have to sell. So I think that's going to be the
See,
biggest opportunity.
taxes, you can forecast taxes, but you can't forecast insurance.
Right.
So that's the challenge when we're underwriting. How are you guys underwriting when you have the same challenge?
So the first thing that we tell a borrower on something like that is go get quotes.
Okay.
Immediately get quotes. Because we found that even as savvy as our underwriters are, that we're off by 30 to 40% a lot. It's not every time, but we're definitely off.
Yeah, I
So
always tell
that's
my
impacting
students
the
to get
proceeds.
quotes. I tell them to get quotes from you, lenders, and get quotes for the insurance, because you have no idea, what's going to happen. I had a deal last month where I got a quote um from an insurance carrier. The deal, we didn't get it. It came back on market, and I went back and got another quote, and it was I think $20,000 more.
Yep.
On a
Sounds
hundred
about
thousand
right.
dollar quote. We got a $90,000 quote, and it came back at 110.
Mhm.
Just a month later. It was crazy.
Yep.
Um, what's your thoughts in regards to the Fed and the interest rates in 2024?
So I did 2 conferences where I was on panels in the last 3 weeks. I know everybody wants to think that rates are going down. I'm not in that camp. Everybody
Uh-oh.
on the panel that I sat on was projecting that rates are going down. And I was like, sorry, I hate to be the buzzkill, but I don't think that's the case.
What's
A couple reasons why. Uh, I think we're in a trading zone. I think 5 to 6% for commercial rates across the board is probably makes sense. I think the everybody got drunk on 2 and 3% interest rates, and it's just not sustainable, because you have people that are buying deals, they're pumping the rents, and then the rents aren't affordable. So now you're creating occupancy issues, or people have to move. Instead of going from a C class to a B class building, they've got to go from a B to a C class building to be able to afford their rent. I think it keeps the market in check. I think it creates
So at the time of this
opportunity for
recording,
people.
where are
Sorry,
rates?
sorry, go
At the
ahead.
time of this recording, where are rates today?
So a conventional $20 million deal, you're going to be somewhere between, call it 5.75 and 6%. On a small balance deal, 1 million to 7 million, you're probably going to be in the mid sixes.
Okay, right on target.
So yeah, I mean, I think that I watch the treasury market every day. We seem to be trading in that 375 to 425 range. Um, if gas continues to trend up, that's the one thing that I really look at, because that's the cost of goods. Everything's got to travel via diesel or gas.
Hmm.
And if it goes up, everything else goes up.
True, true, true. Do you see any easing of the credit boxes this year?
No, I think that from an underwriter's perspective, they're going to hold firm on whether it's a 120 or 125 debt cover. They're going to look at the borrower's liquidity. They're going to look at their experience. They're going to want them to have more experience versus less. Where, we've been able to get away up until about 18 months ago, we were able to get away with, first time buyers going from call it a fiveplex to a 25 unit building, and not having that be a big deal. Now they're going to dig into property management experience. They're going to dig into the liquidity that the borrower has. Who's in the partnership? Is it 3 new guys, or is it one experienced guy with 2 new guys? So they're going to look at and probably want more experience versus less.
Okay. And for those who don't know, just briefly explain, I know you just did, what a credit box is.
So the credit box would be the debt coverage ratio that the property's throwing off, the quality of the asset, the net worth, liquidity, and experience of the borrowers in the LLC, if it happens to be an LLC, if it's just an individual looking at their experience. I know that liquidity has become the number one thing that they look at. They want to see a minimum of 9 months liquidity when they're doing a deal.
Okay. I mean, that's not too far off. It was 6 prior to all this, so right, we're not too
Right.
far off. What are your thoughts with regards to your company? What are you guys going to do?
Well, I can tell you that we're lean and mean at this point. We've always been fairly lean and mean, unlike some of our competitors, Berkadia, CBRE, where they hired a ton of staff and they've been laying off a ton of staff. We have had some attrition of our production force and our underwriting force, but that's just due to the simple market dynamics. But as a whole, I think we're in a really good position to, deploy Fannie Freddie money. We're also creating a whole capital markets platform. So we're hoping to have a couple of different bridge lenders that we work with, a couple of different life companies, a couple of different CMBS options, and a couple of construction options. And the more we can fulfill that need for our clients, I think we're in a really good position.
Okay. So, in your opinion, what are some of the asset types that are going to perform better this year? And what are the biggest challenges that they may face?
So I would say it's always going to be multifamily will always probably do well. Industrial is off the rails good at this point. Self-storage is really a good place to be as well. I think obviously office is going to continue to struggle as long as everybody has hybrid work schedules, and that also affects the retail. You look at New York City, and you look at Washington, D.C., which still have a pretty big work from home policy, and it's killed the retail, it's killed the restaurants. Until that stuff picks up, those retail and office are going to continue to struggle. I mean, I say that with caution because I look at the retail here in Arizona, and almost everywhere you look, it's full. But we also have a huge influx of West Coast people moving here, which is fueling the need for more retail.
But plus, they think it's cheap over there compared to California.
It's not cheap anymore. It's like Florida.
That's what's happening here in
Half a
Florida.
million
They
dollars
think
doesn't
it's
hardly
cheap, but
get
it's
you
not
anything these
anymore.
days.
Wow. So, what direction do you see cap rates going in, and the values overall?
Cap rates have to go up, property values have to come down a little bit. When you have some people sitting on the sideline, they don't want to buy something at 60% leverage. They will prefer 65, 70. It's going to affect the values. It's just simple market dynamics. If they're going to sit on the sideline, eventually the seller is going to take less for the property. I've watched a couple of deals here in Phoenix and in Tucson. They put them on the market, taken them off the market, waited 6 months, put them back on the market at a lower price. And the lower price is still too high.
Right. Wow.
So, it's just a matter of the market coming back into check. I think prices were overinflated for a while. And I mean, maybe by 10, 15% in most markets. But I think that slowly will come back into check here in the next 12 to 18 months.
Do you see that as being an opportunity for someone getting in as a buyer?
Yep, I sure do. As I am a buyer, and I've been sitting on the sidelines for almost 3 years now.
Okay.
Because the market went crazy. It went from 150 a door to 350 a door. And even in Tucson, where you could buy something at 75, 80 a door, is now trading at 135. So yeah, I think that there's going to be some really good buying opportunities. You just have to be patient in the marketplace.
Okay. Now, there's a lot of debt out there for CRE and multifamily, and it's going to mature eventually. What do you see happening with that in the next couple of years?
So it's going to go two different ways, or sorry, three different ways. There's going to be some foreclosures because people aren't going to be able to get out from underneath the deal. The other option is they're going to want to stay in the deal. So if they're a syndicator, they're going to go out and raise the capital from their group
Capital
and
call.
do a cash in refi, or they're going to sell the deal. And sell it probably for not what they thought that they were going to sell it for, but it'll be slightly off where they anticipated being. But it's definitely, we've taken a building back from a syndicator who just couldn't manage it. She sold off the rest of her portfolio here, mostly at a loss. I think she had one that was like break even. But we're starting to see deals that were underwritten, at 20% rent bumps per year. It's just not sustainable. 3 to 5 is
Somebody
stable.
underwrote 20% rent bumps.
Mhm.
Okay.
And they were getting them. They were getting them.
Yeah, but you
But
never underwrite to that.
yeah, you would never underwrite to that. Yeah, they were getting them, but they're not getting them anymore.
I
So
have my
that's going to
students
affect.
listening in, and they probably heard 20% rent bumps. They're like, "What are you telling us, Phil?"
Yeah,
Because
yeah.
I tell them 1 to 2, 3%. But wow. Okay, so what are some of what's the active lender environment right now?
So the regional and national banks are pretty much on the sidelines, maybe for their high net borrowers they're lending. The credit unions have really been filling, and the smaller credit unions have been really filling the gap on the banking side. Um, but the agencies have been slow too. But that's just partially driven by transaction volume. Transaction volume is off by 60% last year, and it's probably going to be off by 50% this year. So that's affecting, where rates can actually truly go.
Okay. So from the what you're underwriting right now, what are the hottest MSAs that people are drawing to right now?
Texas as a whole is still a hot market. I don't know why. I mean, I get it. There's no income tax, but the taxes are abysmal in the state of Texas. Your real estate property tax. But they still, that's a
Any
super hot
specific
market.
markets in
Florida's a
Texas
hot
hotter than
market.
others?
I'm sorry?
Any specific markets in Texas hotter than others?
Dallas, Austin, Houston has been fairly popular. My experience with Houston is that the properties seem to be harder to manage. Denver's a hot market still. They've never seen a downturn. Salt Lake City is crazy. They're starting to see a slowdown in leasing velocity in Salt Lake City and this in the following areas, but still, I mean, they had wait lists before, and same with Denver. Now they're starting to see that people aren't moving as much as they were, but you're still attaining, if you're fresh out of the ground, you're still attaining 90% occupancy, usually within 3 to 6 months.
Mm. So what are the most what's the most important underwriting criteria right now in this environment?
It's definitely controllable expenses, making sure that people are watching their controllable expenses, which are, property management, electricity, gas, water, things like that. In trying to make sure that the property cash flows correctly. Definitely focused on borrower liquidity, borrower experience on stuff like that, and the debt service ratio.
Okay. I got some people listening in, so I'm gonna. If you guys have questions for Matt, chime in and ask him the question while you have him here.
I believe you made the question already about the MSAs with the hottest right now. And I was just curious, why would that be? What's locally what's going on this market that are staying that hot consistently for that long?
Economy. Austin's been very friendly to the tech business. Dallas has been friendly as well to the tech industry. Tesla's building in Austin, outside the airport. The facility is insanely massive. I feel like when you drive by it, because I was there a couple of months ago, it takes you about 5 minutes to drive by it. I mean, I'm joking, but it's really that big.
They say everything's bigger in Texas, right?
Right. And it's, it's in the middle of nowhere. It's in the middle of nowhere. But, it's tech friendly. Dallas, USGA moved to Frisco, which is, North Dallas. They put in a huge facility up there. But it's just business friendly environments. Companies want to move to business friendly environments, which is driving the hot MSAs.
And did you say the taxes are abysmal in Texas? What do you mean by that?
So I'll just pick an example. If you have a $360,000 house that you bought in Texas, in Dallas, or in anywhere in Texas, say 3 to 5 years ago, you're paying $1,000 in taxes on the house every month.
Wow, that's actually low. Yeah, I understand what you mean by abysmal now.
It's
We
painful.
we pay 1.5% here in Florida. What is that ratio in Texas or in Arizona?
Well, here in Arizona, I think I pay $3,500 a year in taxes on my house.
Okay.
About the same here, yeah.
Okay. So that
Roughly, it might be 4,000, but it's somewhere in that range. It's nothing like Texas.
I have a question for you, sir. What do you think of the secondary MSA markets in Georgia?
I've done a few deals in the suburbs and outside of the Atlanta MSA. I think they're fine. I don't think that I think secondary MSAs are a good place to be.
Thank you.
I do have maybe a silly question, but I'm kind of coming from a sales background, trying to see, trying to get into the other part B. Besides the experience and liquidity, how important are, for example, let's say credit scores when you are
Credit
the
scores,
underwriter?
it's important, but I mean, like, we'll accept a 680 and above. You might have a little more scrutiny if you're on the 680 range, but it doesn't come up as what I would call a super pressing issue. If you're above a 680, they just kind of take it for what it is. If it's under a 680, they want to understand why it's there. And sometimes if you're in a partnership and you got 4 guys they're in the entity and one's got a 650, they either make him a minority partner in the LLC, meaning that they put him under 20% ownership, or they take him off of the loan completely.
This question got emailed to me earlier. When you're underwriting and you put in a reserve, that reserve is only there in the kitty, so to speak, for that first year. What is the lender's requirement? Is it to keep more and more, or?
It's just for future repairs on the property, make sure that they're going to get done. Fannie is a little bit more restrictive than Freddie in respect to that, but it's just basically they want to make sure that the reserve is that the repairs are getting done on the property.
But it's not a
I can tell you
cumulative.
that
It's not a cumulative number. Is the question that was asked?
no,
That's what. Okay.
it's based on the property,
Right.
and it's done typically the age. So a newer property would be like 250 a month. Property that's 15 years old would be like 300, and property that's 20 years old would be 350.
I usually just take them all and underwrite them at 300 myself.
Right.
Yeah.
I have another question, sir. When you said previously that you guys are typically looking for 9 months liquidity, you're talking about that the guy has a reserve of 9 months for the mortgage and expenses, correct?
Correct.
And now another question besides that, what is the most important thing I can do when presenting something to a lender for money? besides crossing all my T's, my score, writing it up, what is something that will stand out when I send you guys a document, looking for money?
So it's going to be a little different so we're a non-recourse lender, so we don't require tax returns. But if you go to a bank, it's going to be typically recourse. And they're going to look at your tax returns. That's going to be the key, and they're going to run a global financial on you. Whereas where I sit, we're looking specifically at the property and the cash flow that the property's throwing off, and then secondarily you as the borrower.
Okay.
So I would
thank
say
you.
the most important thing is making sure that you have the correct numbers on the property that you're looking at, and get a T12, meaning when I say a T12, meaning the trailing 12 months broken out monthly for the income and expense, and a rent roll that has the unit mix and the square footage.
Thank you.
I thought you were going to say all you had to do is be a student of the multifamily graduate program. And
Right?
I have a question.
Go ahead.
Sure, go ahead.
Okay, so with all these changes that are happening in the industry, how is this, if we are doing, starting a syndication, how is this going to affect what we are promising our investors? Sorry about that.
So, you have to look at, like I said, I said this the other day at the conference, get an insurance quote and make sure you have your taxes corrected. And then work into the deal and underwrite it. Because those two things are going to be the most critical to understand of what kind of profits you can return to your investors.
What bump do you put on the inversion cap rate when you're looking at a deal?
I mean, if you're asking for traditional exit underwriting from a Fannie Freddie, it's about 6 3/4.
6 3/4 on the
For
back
cap
end.
rate.
Okay.
Yeah.
You're not putting, like, if you buy it at a 5, you're not putting like 7 at the inversion cap rate?
No. Yeah, so they're gonna bet that if it's a 7 or 10-year loan, that if you're buying it at a 5 cap today, it's got to exit 10 years from now at like a 6.75 or something
Okay.
higher.
Okay, 1 point, yeah.
Yeah, they call it a
0.75. Okay.
refinance test, basically, so that you don't end up with the logjam that we're seeing over the next 24 months.
Yes. Okay, that's good.
I have heard and this is from I was trying to help a customer with buying a portfolio of single families, right? And the word like different DSCRs from 1.1 all the way to 1.3. So
Yeah, it's lender specific. The more
Mhm.
aggressive lenders are going to be the 1.1. The more conservative lenders are going to be like the 1.3.
Okay. So we went to underwrite, would we say for doing a 1.3, or you think that's because obviously we don't want to come up with underwriting and then missing the deal,
125 is a
125.
good rule of thumb
Great.
to
Awesome.
use.
Okay.
And so if you wanted to crunch the underwriting a little bit more, you could do it on a 25-year AM versus a 30-year AM, but 125 is pretty much the gospel of underwriting.
Great. That's awesome. Great tip. Thank you so much. Appreciate it.
You got it.
Okay, so Matt, I really appreciate you coming on. And I'll give them your contact information. I think they already have it, actually. To, if they need a loan from you, they'll get a hold of you.
Absolutely. My pleasure. Thanks, Phil.
Thanks for coming on.